Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash flowing properties in today's market. Here's your host, Gabe Peterson.
All right, we are back with another episode of the Real Estate Investing Club. Today we have Chris Linger with us from Upplex. Chris is a seasoned investor getting started way back in 2006 before the epic crash we had back then in 2008. Chris has a lot of experience from back then. I will let him tell his story, but I am super excited to have you on, Chris. Thank you very much for hopping on the show.
Appreciate it, Gabe. Thanks for the invite.
Absolutely. I told you before we got on here, we like to start with stories. We like to hear how people got to where they are today. I know you got a good one, so why don't you take us back to the beginning, way back in 2006? How'd you get started in real estate?
Yeah, so I'm actually a 26-year veteran of the Navy, and through that, we moved around a good bit and picked up properties here and there along the way. So accidental landlord kind of thing. But about halfway through my career, somebody mentioned, if you own like 10 homes by the time you retire, you'll be set for life, type of thing. And I enjoyed, once I started that process of being a landlord as opposed to just selling them when we left type of thing. And it was an incredible concept to me. And so that was the 2005, 2007 timeframe when we left that particular one. That started me off. Fast forward about 10 years, I met my now wife. Between us, we had about 4 apartments, 4 doors. In 2017 is when we met. By 2020, we had grown to 35.
Wow.
So we found that partnership was a huge factor for growth. In 2020 is when I retired. September of 2020, I retired from the military, and we switched to the syndication model. We had already been looking at it, but because of my active duty, she was a reservist. We didn't feel right being in charge of other people's money, with the potential to deploy and lose access to internet and all that good stuff. So we held off until one of us was out. Since then, we have sold most of our portfolio. We took that money from the sales of those, where we tripled most of our investment dollars, and we went into a couple of joint ventures with mobile home parks, self-storage. We've done a few notes. When we sold those properties, we did some seller financing for down payments that have allowed us to continue to cash flow for properties we no longer own. And then we moved into syndications. We went into mentorship for that. And we now are in over 1,800 apartments as general partners and another 1,000 apartments as passive.
Wow, that is quite the trajectory. It sounds like the bulk of the activity happened within the last 3 years, which I just want to highlight because it just goes to show when you really have your eye on the prize of financial freedom, it can happen very quickly. I know you had a few properties before that, but people always think it'll take 20 years to reach their goals. It won't if you really focus in on it. So it sounds like you sold most of your properties you divested of your portfolio to move into commercial. Just kind of walk me through that process, your thought process. Why did you sell what you had and focus in on the commercial side of things?
So we had everything from a single family to an 8-plex, most of which were quadplexes, and we were self-managing, which is a huge time suck, especially when they're spread out across Austin. We're from Austin, Texas. That's where the majority of the portfolio was. We had a little bit in Killeen, a little bit in Temple. Those were about an hour away. Self-managing, we had the systems in place to deal with it all, but it still was a lot of extra work. And so we were looking for...
You were self-managing while working, correct?
For the last 3 years of my career, yeah.
Yeah,
we were. And my wife is also anesthesia and was working in operating rooms and stuff like that as well. So there was a lot of different factors there that came into play, but we wanted stuff that was a little bit more hands off,
Hmm.
where we had somebody else doing the day to day, and we're more responsible for the monthlies, the bookkeeping, the processes in place, stuff like that. We had done before we knew for sure that I was getting out, we looked at notes as a
Mhm.
possibility. So we did some training for notes, and that's why we felt comfortable when we sold. We did that seller financing and took on a mortgage, a second position mortgage, so that we could maintain the income even though we were selling off things. So we went from 35 doors. Now we only own three, one of which is our primary.
Wow.
So
Love it.
as far as that portfolio goes.
Yeah. And it's really interesting that you chose to sell with seller financing. On this podcast, every time I get an opportunity, I like to tout the benefits of seller financing. I think it's a benefit for the buyer. I think it's a benefit for the seller. But it's interesting. Most people don't choose to use seller financing. So why did you make that decision to go through and sell your properties with owner financing?
So our entire portfolio, we owned ourselves, those 35 doors. If we were to sell all of those, and I had just retired, so all of our income would have shifted. There would have been almost nothing. And what we did was we had them still do a primary for their original bank note. And then the seller financing side, it was investors that we already knew that had their own portfolio here in Austin.
Mm,
And so the very first property, we did a lien on one of their other properties that we knew had enough equity in it to be able to withstand that. And then every property after that, they just um, did the second note on the property they had just purchased from us. So we
okay.
already knew the properties really well, and that gives us a cash flow. I think for those five notes, we're bringing in roughly $6,000 or $7,000 a month.
Not bad.
So it works out well for us, yeah. And those guys, like you said, it's a buyer benefit because they were able to get in these properties for like $3,000 and $5,000 for like an
Yep.
$800,000 property or $250,000 property, anywhere in between.
Yep. And I'm selling a property right now as we speak. We're in the closing process. And I'm giving them 6% or no, 5% interest while current rates are almost 7. So there's also the benefit of if you negotiate with the seller correctly, sometimes you can get interest rates that are lower than you would in a conventional bank. So
Yeah.
huge fan of seller financing. It sounds like you already had these relationships in place, though. So this was not a retail buyer. You didn't list it on the market and seller finance it that way.
Um, I will say we had two of the properties that were listed on the market originally. We had buyers for those, and we were open to that. And then as this other group bought some of our other stuff off market, that became a conversation. We just weren't sure if we were going to be able to work out a sales price,
Yeah.
and obviously we ended up doing that. So, and we did long term financing with them so that we knew we would have this repetitive income for a while, for some of that, and interest only for like a 4 or 5 year period. So they had time to grow their rental income on their side before they really started making the bigger payments.
Nice. That's exactly the structure that I do. Interest only on the front, and then usually I do a balloon at 3 or 4 years with an option to extend if they're not able to find financing. So, love to
Yeah.
hear that. Love that you're a seller financing convert over there or proponent. Let's talk about management real quick because you said that one of the reasons that you decided to divest yourself of the properties is because of the time suck. It was really ragging down on your guys' time. I know a lot of single family investors when they get into self management, they realize that it's not as passive as they thought, and they are looking for ways to kind of reduce the time requirement. So walk me through how you kind of transitioned your management from just yourselves to did you hire property managers? Did you third party property managers? What'd you do there?
Sold it all.
Oh, so you don't have any third party property managers anymore. You don't have
We
any portfolio or any properties that you're managing.
we have the three doors that we currently have. We do as midterm rentals, and actually, right before this podcast, we reached out to somebody local who runs midterm rental portfolio. We're going to sign with her
Okay.
more than likely to manage those fully. Right now, for the last 2 years or so, we've been managing them ourselves, and it's been good. Being midterm rentals, it's like every 3 months you're dealing with the tenants, trying to switch out tenants, but we still get the occasional phone call. So at the moment, we're managing 1,800 units as apartment syndicators. I would rather focus in that direction. We have more freedom of time and space. Uh, Having to manage the ones where we are, it still takes a little bit of your time, not as much. But what we saw in that process is that when you feel like you can afford a property manager, get one.
Yeah.
You will get back so much of your time, and that is so valuable for you, your family. You can focus on your regular business, whatever it is, or growing your business.
Yep. Absolutely. So transitioning a little bit to your current business, you guys sounds like your GPs, your LPs, your everything and above on the commercial side, doing syndications. You spoke my love language when it comes to real estate. I love self-storage, and you already talked about that. So how did you decide to kind of focus in on the self-storage mobile home park asset classes? Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
So, great question. We were actually in a mastermind with some basic, general, all around, little bit of everything type of group. And one of the folks in there is a self-storage guru, and another one is a mobile home park guru. And so for like 6 or 9 months, we're watching these guys, listening to their business plan, and if an opportunity came up to joint venture with them. And so we, of course, jumped on them. And those have been great little cash cows. The interesting thing to the first deal, the first storage deal, was it was her first purchase of her own that she was going to be the first time manager, all this stuff. But we were experts with long distance management, business management, because while we had our 35 doors, what I didn't tell you is I was in San Diego. My wife was on the East Coast. The properties were all in Austin.
Oh, man.
So we had systems in place, so we know how to build those things. She knew how to run the self-storage stuff. We used the ESS and all that for the management, basic management. Anyways, we lucked out. We were selling one of our duplexes to another friend of ours that was getting out of the military. We got the money for that. And just as the bank was telling us that they would not loan on the self-storage because none of us were in North Carolina, it was in Charlotte, just outside of Charlotte. None of us were in North Carolina, and only the one guy that had experience wasn't willing to sign on the loan. And right there on the spot, when she told us in this Zoom call, looked at my wife, and I said, "We've got the money. We can be the bank." And so we financed we're the bank on that property still. It's been 20 months roughly, and we're looking to refinance it or sell, and we'll do really well with that.
Nice. Well, congratulations. I love to hear success stories. Of the two, it sounds like you're in apartments too, but if you kind of had to choose a favorite child, I know it's hard, but if you had to choose a favorite child of the three asset classes, I guess, multifamily, mobile home parks, and self-storage, which one is your favorite so far?
Sure. It's not even a question. Multifamily is where we focus. That is our focus because of the depreciation, the net worth generation that you can get, which would then later turns into, I guess I'll say, cash flow on the back end. When you sell those properties. there's a bigger return on those on that side of it all. What we do like about mobile home parks and self-storage is there's good cash flow. And so with the multifamily that we get into, we can write off that cash flow.
Yep, makes sense.
Yep.
All right. Well, we're running down on the time. Before we move over to the quick question that round, though, it would be remiss of myself if I didn't broach these topic that you actually put down as your title, which is how to protect yourself in a down market. We're coming into what would be a down market. I guess we're in a down market right now, but so kind of walk us through that. What's your strategy for entering a 2008, 2023 sort of depression?
Sure. So we're already seeing some of these deals that have been purchased with COVID. There was a large amount of shift from long-term agency debt because they were requiring such high reserves to variable interest rates, and a lot of people didn't cover themselves well.
Mm.
So for us, the deals we've gone into, we do rate caps so that it limits how high the mortgage payment can go. And but we're looking to take advantage of those opportunities that are coming up where the property isn't performing like it should to be able to cover these higher interest rates because at the time nobody was expecting them. We feel that real estate is one of the best hedges against inflation for your money. You're putting in today's dollars and you're getting out tomorrow's dollars. So you just can't beat that opportunity. So we're trying to offer as many different opportunities as we can. We'd really like to try to do about 6 syndications this year to be able to open this up for investors to be able to help them on their journey. And I know that's kind of a broad and vague answer to some extent, but really we're looking at the performance of that property today to make sure that it's going to be able to hit where we need it to be on the returns for the tenants, or excuse me, for the investors. We try to write very conservatively. We don't jump over on the side of the market will be better later. We always underwrite as if the market's going to be worse when we go to sell, so that we can make sure we're going to perform. And then the rent bumps, we keep those very minimal. After the first year, we keep them very minimal to organic rent growth for the market.
Yep, absolutely. I think that is such a difficult and important lesson to learn in real estate is when you're underwriting, make sure to hedge on the side of things going poorly, because you really do not know the future. Even if you're in, if you were in 2019, 2020, it looked like the market was just going to keep going up, but that's never the case. There are always swings in the market. And so shit can hit the fan, especially if you have something like a variable interest rate. It could really bite you if you haven't built in some kind of cushion in your underwriting. And I know when you get into certain deals, you just really want it to work, and you just want to hedge it a little bit and say, "Oh, it'll be fine. I'll recoup this in appreciation. The market's going to improve. Whatever." Don't do that. Don't put yourself in that kind of situation. So, right on. It looks like we are at time, so it's time to jump into the quick question round. Are you ready?
Absolutely.
Let's do it. Starts with books. I'm a big bookie, so give me 2 recommendations, 1 for general life wisdom and 1 for real estate specific.
Real estate specific, I would say there's the 12-week year. That really it's actually more business, I'll say, than real estate, but business and life. Maybe I went backwards. It really would help you with life. If you've got your goals, you're setting your goals for the year. If you can bring those, everybody underestimates what they can do in long distance terms. 5-year, 10-year, even your 1-year goals, you can actually accomplish them much faster if you look at them as a 12-week year instead. You can get so much more done and so much more accomplished. So that was an amazing book, real good eye opener. And real estate side, man, we read so many. I would say rocket fuel. if you have, like, for our business, Maricela is a visionary. I'm the integrator. And if you can get the right two people together, you can take off like rocket fuel. That book was amazing for our business because it really does go in that direction. Like, you have to have somebody looking forward, and there's so much stuff going on in the background that needs to get put together to be successful and make sure that you're doing the things that you say you're going to do. That it takes two very competent people, but competent in different skills, to come together and be able to make that happen. And it's just amazing.
Nice. And that is why good partnerships are gold. If you got a good one, if you can find a good one, it is definitely worth it, especially when you guys have those complementary skills. And that brings us to the next question. This is for your younger self. So let's go back to the Chris who was just, he was still in the military, 2006, buying that first house. Go back to him, look him in the eye, give him one piece of advice moving forward.
Absolutely. If you get a hold of an asset, don't get rid of it. Don't get rid of it just to get rid of it. Utilize it, build it, like, take your time with that thing, and it will be worth so much more in the future. That's probably my biggest regret is I thought about keeping the very first house, and well, we knew we weren't going back to that space. And so we sold it, very minimal profit, nothing to gain over time. We weren't able to take advantage of depreciation. So that's probably my biggest is once you get an asset, keep it for a while, enjoy it.
And that same sentiment is echoed across so many different episodes. Every investor, I feel like once they get into real estate, they sell their first few properties and they're like, God damn it, I wish I didn't do that. But good piece of advice. Let's move on to the next question. This is for your strengths. All of us are gifted with Superman strengths that we uniquely give this world. So, what is your unique strength?
I will say I am not Rain Man, but when it comes to numbers and crunching numbers, I have a really good recollection of, like, we can talk about almost any deal that we've done, and I've probably got the numbers in my head ready to roll.
All right.
So I'm able to calculate those things pretty quick on their own as well. But once we have a deal going, like, it's I can compare things. I can, like, that's my superpower, is working with I'm a walking Excel sheet.
Man, I'm jealous. That sounds pretty blissful. All right, to the next question. This is about the United States. There's a lot of square miles out there, a lot of opportunity to invest. So, what is one market you are most excited about investing in today?
I'm gonna say Dallas Fort Worth.
Ooh, ugh, I love that one. I'm that's my
Yep.
favorite too. I've been looking for more self storage, so I jumped in.
We've
But
got three
yes,
up on it.
Dallas is great.
Yeah, we've got three properties up there right now. Loving it. We're doing really well. And we've made some great partnerships up there too.
Yep, Dallas is great. Actually, when I went and did a due diligence trip on one of my self storage facilities down there, I was just surprised at one, how big it is. Dallas Fort Worth is massive. And then just the airport. I swear to God, I was driving like a half hour through that airport and I didn't even get to the other side. So, uh, big things down in Texas, as they say. Moves us on to the next question. This is mentors. None of us are islands. We all stand on the shoulders of giants. So, who is one mentor who has contributed significantly to your career today?
Our syndication mentor taught us everything from the broker all the way to the closing table. Brad Sumrock, Apartment Investor Mastery is his program, and he actually has something at the end of March. So if people are interested, please reach out. It might be close on this when this releases, but Sumrock's been doing it for 20 years, and we had friends that were in the program that just added value, when they came back and told us their story. So.
All right. Well, thank you, Brad, for helping Chris get to where he is today. That moves us on to the second to last question. This is tools. Tools form the backbone of every business. So, what is one tool you could not live without?
One tool that I could not live without in real estate would be a property manager.
All right. Property managers are key. And, that is a great tool to have in your tool belt, especially because doing it yourself is a time suck, as we talked about earlier. So, leads us to the very last question. This is for the listeners. You've given us a lot of good advice, a lot of things to think about. I'm sure people want to reach out, get in contact with you. What is the best way for them to do that?
I would say go to up-plex.com, upplex.com. You can fill out an investor inquiry, contact us, schedule an appointment, whatever you need to do. But that's the easiest way to get in touch with us, up-plex.com.
All right, up-plex.com. I will put that URL in the show notes. So if y'all want to reach out to Chris, just go ahead and click a little more in the description. It'll pull down the full description, and in there you could find Chris's URL. Well, that wraps it up. Thank you very much for hopping on the show, Chris.
Absolutely. Appreciate it, Gabe. Thanks so much.
Absolutely. And for everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. And if you guys want to support the show, all I ask is that you give us a like, subscribe, share, whatever it is. That's the best way to support us over here. Other than that, I hope you guys have an absolutely fantastic day. Keep rocking real estate, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at Gabe at therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.